I welcome you all to FCA Accountants Tuition Center YouTube channel. Luando Franklin is my name, the pioneer, the lead tutor, and the chief executive officer at FCA. The tutor with massive, extensive experience in lecturing and training accountants in Zambia. For all the new subscribers, I would encourage you to hit the notification button so that you are able to receive the latest videos. In today's video, we are looking at IFRS 15. IFRS 15, that is revenue recognition and contracts with customers. So it is IFRS 15, revenue recognition. This topic is relevant to the students that are doing or wishing to do the strategic business reporting under ACCA and also the advanced financial reporting under CA 3.1, ACCA, and also those doing CA 2.1 under ACCA. In today's video, we are going to look at I'm going to summarize I'll summarize the 5 steps that can be used in order to determine when the revenue can be recognized. So, and then we are going to do a question together. So, an entity must determine when to recognize revenue. The revenue recognition is done when the performance obligation is satisfied. For example, if an entity is selling cars and the car is delivered to the customer and the customer accepts the car, then the performance obligation is satisfied and the revenue can be recognized. Therefore, performance obligation is satisfied when the entity transfers the promised goods or services to the customer. Then that obligation is satisfied. Now, I want to explain that when the customer has control of an asset and he has the ability to direct the use of the asset, then he has obtained control. Also, the customer can substantially obtain all the remaining benefits from the asset. It means he has taken control of the asset and the seller can recognize the revenue. That is a straightforward one. Now, I want you to understand where the entity sells a car together with the annual servicing of the car. And the price charged is a single amount. Therefore, the seller should be able to allocate the selling price to the car as well as to the annual servicing. And when the car is delivered, revenue will be recognized. And when the servicing is done, for example, if it is 3 years servicing, at the end of the first year, the revenue relating to the first year will be recognized, and the revenue relating to 2 years will be treated as deferred income. So we are going to look at this illustration. I'm going to demonstrate how you allocate the selling price to the car and also to the annual servicing. The allocation is done with reference to the standalone price. Let's look at this question. Allocating transaction price to multiple deliverables. A company sells a car, including servicing for 2 years, for 21,000. So that is for both the car and servicing, but you need to separate, because once a car is delivered and the customer takes control of the car, then revenue should be recognized immediately. But servicing, or rather revenue relating to servicing, should only be recognized when the servicing is done. And the balance for the other year should be classified as deferred income because the servicing is not yet done. The car is sold without servicing for 2520, and annual servicing is sold for 540. That is annual. Now it is 2 years. So that is now the standalone price, and that will be the starting point. Are we together there? So the starting point there will be, we can go, standalone price. Standalone price. Then we get the proportion, P, and then revenue recognized. Revenue allocated. So for the car, when it is sold alone, the price is 2520. And servicing for 2 years. Servicing for 2 years, that is 540 multiplied by 2, it will be 1080. Total, the total there will be 21,600. The proportion here, 2,520 upon 21,600, the proportion there is 0.95. 1080 as the proportion of 21,600, it will be 0.05. So now those are the proportions. Now the total pricing is 21,000. For the car, it will be multiplied by 0.5, which will be 1995. For servicing, it will be 21 multiplied by 0.05. And this will be 10 and the total will get back to 21,000. So there, 19,995. And there it will be 10,50. So the total here will be 21,000. So now at the end of at the end of the first year, year end, a revenue to be recognized will be for the car, 19,950. Servicing for 2 years is 1050. But at the end of the first year, we'll recognize that's 1 year. Servicing, the revenue to be recognized will be half. 1050 divided by 2, that will be 525. So the revenue to be recognized will be the total there. $24.75. The other revenue will be in the statement of financial position. Statement of financial position. And this will be under current, because it's due next year. So it will be under current liability. Current liability as deferred income. Deferred income, which will be 525. Is that okay now? So that we are done. Maybe we can look at one more question. One more question there. This will be we have another question here. Okay, I can read revenue recognition. Justa operates in the telecommunications sector. On 1 January 20X1, Claire, a new customer telephones the customer service department of Justa to enter into a new 24 months contract for a mobile phones. The terms and conditions are agreed by telephone after a credit check is carried out on Claire, and a written copy is then emailed and posted to Claire. Under the contract, Claire receives a free handset at the inception of the plan. That is, no upfront cost, and then pays a monthly fee of $49 for 24 months for unlimited calls, text, and data. The handset is due to be delivered by courier within 24 hours by evening of 2nd January 20X1. Josta also sells the same high-end smartphone handsets for $700 each, and the same monthly payments plans without the handset for $25 per month. Josta does not offer calls-only contracts, text-only contracts, or data-only contracts. Customer must buy the three services combined. So now the first thing that I'm going to explain is there are no free things. The handset, which is said to be free, it's not free. A price should be allocated. First, what is the price when we have the combined services? So the price, total price for the combined services will be there, £49 for 24 months. That will be 49 multiplied by 24 months. That will give us 1176, which includes the handset and the other services. Now, what is the cost for standalone? That is the starting point. Standalone, when these are provided as standalone, standalone price, proportion, allocated revenue. The allocated revenue so we have standalone handset, handset is 700. Then texting, calls, and data. This will be $25 for 24 months. That is 500 and 600. The total is 1,300. Proportion of handset, that will be 700 divided by 1,300. This will be 0.538. And the other one there will be 0.462. Is that the first one? We can check it up. 700 divided by 1,300. That is 0.538. So this one, good. So this is 0.538. So multiply by this amount. So we have 1176 multiplied by 0.538. We have 633. And on the other one, we have 5 543. And this comes back to, so we have allocated. So the answer, there is a price of 633. So revenue recognized at the end of the year, it will be handset because it has been delivered. The handset there, it will be 633. The tax cost and data, it's for 2 years. That is 24 months. Therefore, at the end of the first year, you recognize for 1 year, which will be 271. The total revenue that is to be recognized will be the total. That will be 904 04.5. The other half or the other 1 year will be classified as deferred income in the statement of financial position. So that will be statement of financial position. Under current liabilities, there will be deferred income of 271.5. Okay, so for today, we are going to end here. Thank you for watching this video. God bless you.